Imagine waking up one morning and finding your neighbor got richer without working. No promotion, no startup, just richer. You scroll the news. The stock market is higher. Real estate is booming. The headlines cheer. You don't feel richer. You feel squeezed. That feeling matters because it's not random. It's engineered. Here's the blunt version. The Federal Reserve created roughly $8 trillion of new assets in its balance sheet at the peak of its post-pandemic response, digitally, quietly, from thin air. Short punch? That matters. A lot. Why should you care? Because money created by the Fed didn't land evenly. It flowed into financial assets first, stocks, bonds, and real estate, lifting prices. People who already owned those assets got the gains. That is how a policy intended to stabilize the economy ended up making the wealthy wealthier. Let me show you how the machine works. No jargon, just the engine. When the Fed wants to stimulate, it buys assets, treasuries, and mortgage-backed securities from banks and investors. To pay for them, it credits the seller's bank accounts with reserves. It didn't print paper. It created electronic reserves, ledger entries. Banks see higher reserves. The Fed's balance sheet expands. That's quantitative easing in one sentence. Important point, those new reserves are not a stimulus check to everyone. They sit first in financial institutions. The immediate effect is higher prices for the assets the Fed buys and for closely related asset classes. Stocks rise because investors, flush with liquidity, bid for returns. Home prices rise because financing is cheaper and demand chases limited supply. The next effect ripples outward, some hiring, some credit flows, but the first beneficiaries are asset owners. Let's add numbers to keep this real. In March 2020, the Fed's balance sheet was roughly $4.3 trillion. By May 2022, it had nearly doubled, approaching $9 trillion. That's several $trillion of new reserves injected into the financial plumbing in barely 2 years. Now the uncomfortable math. Say you own $100,000 in the stock market in 2019. Between 2020 and 2021, trillions flowed into equities. Your 100K might have grown 30%, 50%, or more, depending on your mix. Meanwhile, someone who rents and lives paycheck to paycheck saw rents and grocery bills rise, but didn't own the assets that ballooned. That divergence widens wealth gaps. Multiple studies find that large-scale asset purchases tend to push up asset prices and, by extension, wealth inequality. It's not a conspiracy. It's an observable consequence of how monetary policy transmits. There's also a behavioral loop. When markets rise, the wealthy feel wealthier and spend more, which supports growth in high-end services and luxury markets. That sends signals back to markets. More upside, more appetite. The Fed watches inflation metrics, employment, and financial stability, but the first visible effect of its printing is asset inflation, and asset inflation is a fast way to boost the balance sheets of the rich. You might ask, didn't QE also help the broader economy? Jobs, wages, that sort of thing? Yes, to an extent. Lower rates supported employment and prevented deeper recessions, but the distributional effects are asymmetric. The boost to asset prices tends to outpace the boost to wages for ordinary workers, especially in the short run. In technical terms, the asset channel of QE is powerful and concentrated. There's another mechanism that made the wealthy even richer: the way large banks and institutional investors used the new reserves. Big banks parked enormous balances at the Fed and earned interest on those reserves. Large funds used cheap financing to lever up positions in stocks and private markets. Hedge funds and private equity had access to massive liquidity and could buy distressed assets cheaply. Those with scale and access amplified the gains. Smaller investors and savers didn't have the same doors open. Now, irony and risk. The Fed created liquidity to prevent an economic collapse. That worked. Markets stabilized. But the cure came with side effects. Asset bubbles inflate. Risk-taking migrates into less transparent corners. And when the Fed reverses course, raising rates or shrinking the balance sheet, the unwind can puncture inflated asset values, creating losses concentrated in the same pockets that benefited earlier. So who bears the long-term cost? If inflation rises materially, the burden is spread. Savers lose purchasing power, and debt holders find real burdens eased. If asset prices correct, investors and big funds can face abrupt losses. But the immediate visible effect during expansion is that wealth concentrates at the top. Let's be honest, the Fed isn't malevolent. It's doing what it thinks will prevent depression-level damage. But policy is always a set of trade-offs. The trade-off here has been distributional. Stabilize broad economic activity at the expense of inflating asset values, which disproportionately rewards those who already own them. Multiple empirical studies conclude that asset purchase programs are linked with persistent increases in wealth inequality. That's not conjecture, it's research. Where does this leave you? 3 practical threads. First, understand the mechanism. Knowing that a big chunk of economic gains after a crisis can flow to asset owners helps explain why your rent or grocery bill may feel disconnected from stock market cheers.
Second, consider allocation. If policy is likely to keep rewarding assets, diversifying into assets that historically benefit from liquidity, certain equities, real assets, or inflation-protected instruments, can be protective. This is explanation, not investment advice. Third, watch the exit. The Fed can't expand forever. When it tightens, markets that benefited most are vulnerable. That means timing and risk management matter more than blind optimism about perpetual gains. End note. The Fed created trillions to stop a collapse. That move stabilized a fragile economy, but it also reshaped who gained. The invisible printing press didn't create equal winners. It lifted asset values first, and that tilted wealth upward. The policy worked in one sense, no depression, but it also rewrote the rules of who benefits from rescue. Here's the final uncomfortable thought. If rescuing the economy systematically rewards existing wealth, are we content with a financial safety net that leaves inequality baked into the recovery? Think about that.